A very warm welcome, everyone, to the fourth and final webinar of our 2023 Energy Series. My name is Axel Threlfall. I'm editor-at-large at Reuters, based out of London. Our title today is perhaps unsurprisingly, COP28 Outcomes Shaping the Global Energy Landscape for a Sustainable Future. The series is hosted by the Al-Attiyah Foundation in partnership with London Stock Exchange Group Data and Analytics. This is, of course, a great opportunity to get into some of the detail of COP28 and hopefully go away with a better understanding of how the meeting will move things forward in the global energy context. We have a super panel lined up to help us do just that. I'll introduce them in just a moment. Let me do the obvious housekeeping bits first. For the best viewing experience, just look at the instructions above the media player. That'll tell you everything you need to know. Technical issues, refresh the page. If you've got a question, hit ask a question, and I'll try and get to as many of those as possible. I'll try and weave those into the conversation as we go. During the session, I'm going to bring up a number of polling questions. Do participate in those. It's always good to get a sense of where you stand on some of these issues. And just to let you know, the recording of the session will be available using the same event link. Look, we all know the context well enough, so let me keep this brief. As we approach 2030 and that critical 1.5 degree threshold, the urgency to act is greater than it's ever been. Much hope is put in renewables to mitigate climate change. Experts do warn, though, we need 3 times the current capacity, the current level by 2030, if we're to stay on track for 1.5 degrees. Such a scale up, as you all know, raises huge challenges, especially around grid stability, around energy storage. It also requires massive capital. The IEA, I believe, says about $131 trillion will need to be invested in the clean energy transition by 2050 to reach that 1.5 degree goal. COP, of course, is underway in Dubai. I just returned from the meeting myself, and I can attest to the frenetic activity at the expo site on the ground as countries try and hammer out details on, among other things, how to fast track the energy transition generally. On renewables specifically, 118 countries, including the UAE, pledged last week to triple a renewable energy capacity by 2030. So the ambition is there. How we do it is another thing, and no doubt we'll talk about that over the next hour. Countries still very much, I was just looking at the latest wire stories just before we came on, countries still very much at odds over fossil fuels, with a number, including Saudi and a number of the OPEC Plus members, very much against this phasing out language. In fact, a draft of a potential climate deal yesterday omitted that phase out language. So it remains to be seen how that will be settled. Lots to talk about, especially the possible repercussions and implications of this meeting. I should also highlight finally that this discussion is based on predictions from our experts and not to be associated as investment advice. And of course, we should all wait until the final day of COP to better know where we stand. With that, let me introduce our panel. Adrian Del Maestro is VP Global Energy Advisory at the Engineering and Infrastructure Consultancy, AECOM. Paula Van Langenham is Director, Carbon Research at London Stock Exchange Group, Data and Analytics. Dr. David Robinson, Economic Consultant, Senior Research Fellow at the Oxford Institute for Energy Studies. And Nicholas Howarth is Energy Analyst at the IEA. A very warm welcome to all of you. And we'll get into an interactive discussion in just a moment. But before we do, just to help us set a little bit more of the context here, I want to give the floor to Nicholas for a very short presentation. Nicholas, go ahead.
Thank you, Axel, and a warm hello to other panelists and everyone who's joined us online today. If we can just bring up my slides, thanks. I'd like to start by jumping straight into what's been happening at COP and what it means for the global energy system going forward, from my view, as the leader of the IEA's work on its energy efficiency market report, which just came out around a week ago and had a major focus on the topics under discussion at the COP. So we can move to the next slide. The first of these is the proposed pledge mentioned by Axel to double the global annual rate of energy efficiency from around 2% per year to over 4% every year this decade until 2030. This is being considered as part of a package to also triple installed renewable energy capacity to 11,000 gigawatts by 2030. So when we put the slides together, the number of countries that had signed up to this pledge had gone up to 123 countries, and this is a very dynamic environment. The COP still isn't over, and these numbers of the countries signing on to this major pledge has been increasing and may reach towards 130 before the COP is out, we hope. Now, this still represents only about 60% of countries at the COP, and so there is still some way to go in terms of the gap between the countries that are signing up to where we want to be, and the degree to which this pledge will be reflected in the final COP text, which is currently one of the issues under discussion. So if we can move forward to the next slide. And I'd like to just talk a little bit about how energy efficiency and renewable energy pledge interact, because this is really quite crucial, because one depends on the other if we're going to achieve our climate goals. And this is why they've been grouped together. This year, however, even though we have seen this increase in policy momentum, the global average rate of energy intensity progress dropped back from 2% last year during the energy crisis to around 1.3%. And this is still well short of what we see as needed in the net zero scenario, what's required to double efficiency improvement at 4%. Now, this was primarily driven by increased energy consumption this year. We expect energy consumption to rise by around 1.7% this year. This is up from 1.3% last year. And this is the prime driver of why we see this slower progress on efficiency. If we can move to the next slide, just to highlight why this is such an important topic. This rate of efficiency progress, whether it's around 2%, which is what we expect under current policy settings, 3% under announced pledges if countries fulfill their climate goals that they've articulated but perhaps not implemented in policy, and 4%, what we see in net zero, determines if we'll see a high energy demand future this decade of around 1% growth per year, or a stable energy demand future, or a declining lower energy demand future of around 1% per year this decade. And so energy intensity progress, efficiency progress, really determines the pace as well as the composition of the clean energy transition. If we can move forward, please. And just a brief word on what this means at the investment level for efficiency, but similar numbers or themes can be picked up for renewable energy. And while we see a rapid uptick in investment, almost 40% since the beginning of 2020 and the stimulus measures announced since the COVID crisis and energy crisis, we still have quite a long way to go to get to the levels needed for net zero. And also importantly, particularly importantly, most of this investment is concentrated in advanced economies. So there's a big gap that needs to be filled when we come to emerging economies, where most of the energy demand growth, of course, is expected to be. So if we can move on. And one of the major second points that I would like to emphasize is that climate change is already with us. This year was the hottest year on record, and we saw peak electricity demand, new peaks in electricity demand hit around the world in countries representing over 60% of electricity demand. And what this underscores from a efficiency perspective is the urgent need for faster action on cooling, which can help reduce the need for those reduced pressure on those peaks in grid pressures. And in that vein, this COP also saw a very important initiative around a global cooling pledge. 64 countries have signed on to this pledge. And as part of that is the commitment to increase the average efficiency of new air conditioners sold by 50% by 2030 compared to a 2022 baseline. So we move forward a slide, please. And here we just see that obviously this is what we already know. In countries where there's a lot of penetration of air conditioning, such as the United States, there's a very tight relationship between temperature and electricity consumption. And in countries such as India, where consumption is rising faster, penetration of cooling devices is lower. The relationship is still there, but it's weaker, but it's increasing. So we see for every percentage temperature increase, around a 2% increase of electricity in India compared to 4% in Texas. Now, if we move forward one more slide, my final slide, and this is a specific point related to the efficiency of air conditioning and what it means for doubling. But the same could be said for the hundreds of or thousands of other technologies that efficiency intersects with across all sectors. But here we see the efficiency of units on the x-axis and the retail price of these units on the y-axis. And in the green, the units on sale today, that technologies are available, which are consistent with the doubling of energy efficiency progress and the halving of energy consumption to deliver the same cooling. And what's quite surprising is that many of these units can be purchased at the same price. And this is real market data that we've gathered this year in Southeast Asia. So this just underscores that these targets are achievable, technologies are there, they're cost effective, but we need much stronger ambition from governments to bring this to reality. So I'd like to leave it there and thank you for your time for the presentation.
Thank you very much, Nicholas. Very useful for the context, and also I'm glad you mentioned the cooling pledge. A lot of fanfare around that. I was on the ground when that happened. The 50-odd countries that signed up to it, and very notably the US was one of those signatories as well. So it'll be interesting to see where that goes. Just before I bring up the first poll, very quick question for you, Nicholas. You talked about the energy efficiency improvements that are needed. You talked about a shift that's needed on the policy side, a shift that's needed on the investment side. Just on the policy side, clearly new thinking is needed by governments here. What kind of policies or incentives should and can governments roll out quickly to try and fill this gap?
Sure, we go into this in a lot of detail for all the sectors in the market report itself, which is available free online. But what we see around the world today, standards exist somewhere, minimum energy performance standards. And so this set the minimum threshold for energy that can be consumed by a device, whether it's an air conditioning, an industrial motor, lighting. These standards, consistent with net zero levels, are in place somewhere in the world in some country, but not everywhere has those standards. And so bringing up the average level is key, and as is setting a forward path of gradual improvement. So looking at energy, minimum energy performance standards, linking it to incentive programs to give consumers those extra nudge to buy the most efficient unit on the market, which are already in excess of what's needed, as well as information campaigns. Often this information on efficiency, it's not front of mind when consumers might be buying a car or their lighting. So making sure that the information is there as well.
Good, thank you, Nicholas. All right, look, I think you can see the first poll question up on your screens, and we're going to take a step back now from that bit. And this is the question: which of the following policy approaches to decarbonize the power sector will intensify following the COP in Dubai? Carbon tax mechanisms, cap and trade systems, incentives for renewables, an industry-wide standard for CO2 per kilowatt hour. To have a crack at that, I'll bring the results from the polls up in just a second. Whilst we're waiting for that, though, I want to bring in our other speakers. David, let's kick it off with you again, stepping back. And I mentioned the difficulty, very unsurprising that we're having this difficulty on a final draft of an agreement on the wording on the fossil fuels piece, this phasing down versus phasing out. Is there any way the Saudis and other OPEC members are going to go for this phasing out language?
Well, it's very difficult, but if I were in the room, I would be focusing on the word, two words. One would be the word just transition, and just implies that the rich countries have to decarbonize first and stop, if you want, producing oil, gas, and coal first, leaving China, India, Saudi Arabia as, if you want, coming later. And the second term I would use is unabated fossil fuels. So in that case, you're leaving the door open for not just CCS, but other abatement mechanisms. And I think that, again, I don't know how far they will move, but if I were to guess, I would say it would be something like a ordered and just transition to unabated fossil fuels.
Okay. And look, by the looks of it, I had a look at a draft text yesterday. Those words are in there right now, it seems. But how confident I mean, this is a big question, but you know, when we look at that, the just transition, unabated, we listen to Nicholas on the renewables piece and the energy efficiencies piece. Look at the loss and damage money that's available. How optimistic are you that we can move away from where we are now and develop a new system that isn't heavily based on hydrocarbons?
I'm very confident, but it has nothing to do with what's decided today in the COP, however important that may be. I think it has to do with the economics. And what I think we see is a very rapid shift to renewable power, which was initially explained by subsidies, but is now explained by significant reductions in costs. And over time, we'll see those costs falling further, both in developed countries and in developing countries. So, I mean, to start with, I think what we'll see is a very quick development of renewables. I'll get later to some of the, or later in the conversation to some of the barriers, but I think that's going to happen because of the costs.
All right.
The second thing, you see that similar thing with electrification. So I can go further into that, but I think it's the economics that will drive this.
Yeah. Okay. Paula, let me bring you in here and get your general thoughts on the extent to which you feel this process has moved forward over the last couple of weeks. You know, what are the issues that energy companies should be most concerned about? You know, what are the business implications for the energy sector on the back of COP? What are the priorities from where you're standing?
I think there's still really a lot of questions about what the future looks like in general. The longer that there's sort of negotiation and debate about what this looks like, the harder it's going to be to really make long-term plans. There's been a lot of back and forth as well about sort of what the expectations are going out into the future. And that really just from an investment standpoint makes things just a lot more difficult in general. I think what we see, particularly when you're looking at carbon markets in general, is that there's really a desire to just have rules. People are just keen to just have rules at this point, and they're happy for them to be one rule or the other rule. It's just making sure that those are actually kind of hard coded. And the fact that there's been so much kind of back and forth and walking back on certain things, I think has caused a lot of general uncertainties in terms of what you can expect for investment, and that then, you know, creates some additional questions about how you're actually going to move forward from there.
Yeah. Okay. I'm just getting the results for this first poll, by the way. Interesting. Not surprising, but interesting. Incentives for renewable generation come out tops with 67%. The lowest, though, is carbon tax mechanisms, and I know this is an area that you look at. Paula, and we'll go more into the carbon markets a little bit later on. But the fact that no one is putting much on the carbon tax piece, is that surprising to you?
Not at all. In terms of actual sort of carbon policies, it's probably the lowest bar you can really kind of hit. It's not a very responsive or flexible policy, so it doesn't respond very well to market conditions, and they tend to be quite low. So as a result of that, it doesn't really capture efficiencies very well as they kind of improve over time. And of course, then it becomes very difficult to amend them because it's not reflective of market conditions. There are quite a large number of countries with carbon tax systems in place, and they haven't really prompted larger decarbonization than would have been possible with improvements in technology, just kind of moving the way that you would expect them to. Other markets, other sort of carbon mechanisms are, I think, a lot more effective at providing kind of consistent and changing price signals depending on how the market is moving and how technology is developing. So that's sort of where the effectiveness of cap and trade systems can be particularly powerful in moving towards decarbonizing the power sector, which of course we've already seen quite effectively within the EU, where power is included under the EU ETS.
Exactly, and by the way, cap and trade was option B, and that came in second under renewables. All right, Paula, thanks very much indeed. Adrian, just a general thought from you on the transition broadly. Just characterize where you think we are now in the transition.
So I think that the expression that always comes to mind for me about the transition is pace, scale, and complexity. On the one hand, we've got the urgency of climate change that we've all heard about and are aware, and that's becoming more acute. And at the same time, we've got an energy system that's highly dependent on hydrocarbons. And at the same time, we're trying to build this new low carbon energy system at the same time, with less time, enormous complexity, and just the scale that we got to do it at. I mean, we talked about the tripling of the renewables commitment. Last year, 2023, I think we added capacity additions in renewables globally were about 500 gigawatts. To hit that tripling target, we're going to have to double that year on year, in terms of 1,000 gigawatts each year, which is an enormous amount. And I think the last time we trebled our renewable capacity, I think it was between 2010 and 2022. So it took us 12 years. We got 6 years now to triple it. So it's that scale. I think we're making progress. I'm an optimist about this. You can see enormous progress in terms of the collaboration between governments and the private sector, bringing the investment, the capital, the innovation to build these energy systems. It's just that we have to keep that momentum going and increasing it all the time.
Again, looking at some of the stories that Reuters has been putting out over the last couple of days on the renewable piece, and given your role at AECOM and what the consultancy does, it seems to me, this idea of tripling, and 123, I think Nicholas was saying, 123 countries have now signed up to this tripling of renewables, but there's very little detail. When you get into the weeds of it, there's very little detail. And it seems to me that this whole issue of permits, leases, grid connections, all of that stuff are going to be the real stumbling blocks here. What are your thoughts?
Yeah, so I think David was keen to explore this. So I think there are some significant barriers about delivering that renewable growth, and you've just alluded to some of those. So there are issues around permitting. There's issues around stakeholder engagement. If you think about the need to build transmission grids, for example, you're going to have to work with a lot of consumers, local stakeholders, who will have to agree to those pylons being built, for example, and you need to engage them. You need to provide incentives, right? You need to have the capital to deploy. We're seeing significant capital already coming in to clean energy, 1.8 trillion for 2023, but that needs to grow significantly. And the cost of capital varies according to geography. So if you think about emerging markets, the cost of capital is much higher than in developed markets. So I think there's lots of challenges there, and there's not a lot of talk about the grid. The grid is very much the backbone to the energy transition. We've seen investment in grids pretty flat the last few years, around about, I think it's $300 billion a year. That's going to have to double to about $600 billion by 2030. And a lot more grid that needs to be added and adapted. I think the other thing that we've not touched on yet, and I'll mention it briefly, is the business environment that we're facing. And I think that's going to make it also challenging, because we're in a world of higher interest rates, cost inflation, strained supply chains. It just makes it harder for companies to deliver these low carbon projects, because they need to focus on those projects that are bankable, that they know are commercially feasible. To David's point, the economics are really important, and they're becoming even more important. However, I do want to finish always on a positive note. However difficult some of this may be, just look at the progress we've achieved between that collaboration between public and private sector. We've got the mechanism there to deliver it. We just need to accelerate more.
All right, David, it'd be good to get your thoughts on this. What you feel the biggest stumbling blocks are. And yes, the economic context is a tough one. Yes, the focus on bankable projects and returns on investment is absolutely critical now. And I sat with a number of the big banks in Dubai, and heard that story. These projects need to be bankable, whether we're talking about mitigation or adaptation, and I'll come on to that. What for you is the biggest problem here?
Yeah. Well, first of all, I agree with what was said. That the especially issues of public support for building networks and building out renewables is very, very big. But I'd like to focus specifically on the issue of the future of gas in the electricity sector, because we're talking about an electricity sector which will go from maybe 20% to up to 60 or 70% of the future energy system, and yet intermittent renewables just don't do it on their own. And we need, therefore, currently to depend upon gas, possibly coal. So the question is, how do we introduce short and long-term flexibility into the system in order to not require gas to balance the system? That's a security of supply issue. It's also to do with short-term intermittency and stability of the system. So I think that we have to focus more on the new sources of flexibility, which include themselves green hydrogen, which could be an important source of flexibility. We're talking also about the growing importance of demand flexibility of batteries. So I think it's really a question of ensuring that we're giving incentives, not just to build renewables, but incentives to be building the flexibility into the system.
Yeah. Nicholas, just a quick thought from you on that, and then Paul, I'll come to you on financing. But when it comes to greater energy efficiency and filling these gaps, as we've said, obviously most sectors are in sort of need of this. But which sectors should we be focusing on now? Which sectors need these improvements now, and more critically than others, would you say?
Well, I think there's sectors where we're moving fastest, and the potential momentum is already with us. We see a lot of momentum around electric vehicles and electrification of transport. That's picking up fast. Also around heat pumps and electrification of residential gas, which is leading to an expected peak. These two things combined, leading to an expected peaking of gasoline demand globally at the moment. So we see this over the next couple of years, a possible peaking of gasoline demand globally. We also see a peaking of residential gas consumption in countries representing over 50% of residential gas demand, and that's another megatrend. So these end users are really leading to peaking for some really big segments. But in other areas, we're moving too slow. And I think industry, if we look back into the past, has been moving slower than buildings and transport. And if we look into the future, this is also the sector where we see the least contribution in terms of overall energy savings. But I would just like to jump in on a couple of the very good points that were made on the need for flexibility. As renewable energy expands in the energy system, the role of energy efficiency evolves to something more than just providing energy savings. It becomes more tightly scoped to delivering energy consumption when renewable energy is at its highest, smart grids, batteries, building energy management systems, and all of this helps reduce the need for that grid infrastructure. And so renewable energy efficiency should be better together and considered as part of this integrated concept. And I think this is a relatively new development, and it's something to be welcomed with the COP pledge for the triple up and double down on renewables and energy efficiency.
Okay. Look, let me bring this next poll up. Again, I think it'll inform where we go now. What outcome from COP28 are you especially looking forward to? We've talked about a few of these things: national policies, stronger incentives to aid the transition. We've talked about that to a degree. Greater opportunities for cross-border public-private partnerships. These two last ones I would like to get into a little bit. Mobilization of financing and investment for the energy transition in developing countries, and more transparent and effective carbon marketplaces. And Paula, let's just, and we'll wait a little while to see what our audience is saying on this. But Paula, on the more transparent and effective carbon marketplaces, again, I know you wear the carbon markets hat here. It's been hard for the carbon markets over the last few years, whether it's Guardian investigations or others into integrity and into quality. One, how valid do you think those concerns are? And two, do you think organizations like the Integrity Council for the Voluntary Carbon Market and organizations like that are clearing things up and are going to clear things up adequately enough for businesses to get back into the voluntary carbon market?
So a couple of things, because that's actually a very big question in several ways. First of all, I would actually argue that D and C in this example of the poll are actually quite related. Carbon markets are one potential tool of mobilizing financing and investment for the energy transition in developing countries. So they are somewhat related. And the biggest challenge with that, of course, has been this question of transparent and effective carbon marketplaces, specifically for voluntary credit-based markets, which is different, I think, than some of the other carbon markets that we have historically discussed. So there are two different types of carbon markets. There are sort of allowance-based markets, which are sort of driven by national ETS systems. And then there are credit-based markets, which are largely voluntary, although there are also some nationalized carbon markets as well that are based around credits. And to sort of move on to the second part of your question, will things like the ICVCM improve transparency in those spaces? I mean, potentially, in the sense that they include guidelines around which voluntary carbon markets are supposed to follow, but it doesn't change the questions around whether or not certain participants in this space actually see voluntary carbon markets as valid. You're still going to ultimately have some of those questions, and so it might clear up some of them, but it won't necessarily tackle all of them. You sort of need to start looking at it of whether or not you're willing to accept that there will be some uncertainty in a crediting-based space, because credits are, there is always going to be some subjectivity about the effectiveness of credits, whether you're talking about removals or whether you're talking about avoidance-based credits. Whether they're managed in a national or international way, or whether they're purely voluntary. It's always going to be that way. Whereas allowances are much more sort of straightforward. That said, you need credits to hit net zero. So at a certain point, you kind of need to accept that there's going to be that level of uncertainty and that level of question. The question is sort of where that line actually falls. And so things like the ICVCM will probably help putting in those barriers, as will sort of any potential agreement around Article 6.4 and 6.2, which currently doesn't look super likely this COP again. That will also sort of help create those lines, but it will not necessarily fully address some of the outstanding questions that remain around carbon markets.
All right. And by the way, the result of this poll, C, option C, the financing for developing nations, yes, linked to carbon markets, of course, came out tops on 56% here. Adrian, what are you hearing from your clients on carbon markets, carbon offsetting, integrity? What are you advising them when it comes to them wanting to get back into this space, but a little bit wary given the reputation?
So I think there's I mean, just generally, in the same way that there are a portfolio of technologies that will help us to decarbonize, there's no single silver bullet. There are a number of options that companies can consider to reduce their carbon footprint, and offsets voluntary carbon markets is definitely an avenue. I think there's always, as Paula was kind of suggesting, I think we just need to be cautious about some of those because it's an emerging market. I've heard some people refer to them as a little bit of the Wild West. They're about worth something like $2 billion in market size now, and it's going to likely balloon by 2030 to over $100 billion. So it's really small now with enormous potential. But I think until we see much more transparency and regulatory standardization, I think they just need to be careful about that. And I think companies need to still focus. That's a tool that they can use, but they still need to focus on the other aspects of decarbonization. And I think we're reaching an inflection point now. When I look at many corporates, a lot of those net zero announcements and commitments came out in 2019, 2020. Some of the easier decarbonization efforts have already been done. So think of like decarbonizing your vehicle fleet. That was quite a relatively easy thing to do. I think they're reaching an inflection point now where some of the technology is not available that they're looking for to help decarbonize. If you think of like heavy industry, for example, and therefore they're seeing their interim emission targets approach, and they're thinking we still haven't done the heavy lifting yet. And I think that's where we're reaching an inflection point now. And again, I think that business environment that I mentioned earlier, it's making it harder for them to decarbonize as well. So I think offsets are a helpful mechanism. I think it's a market that needs to evolve, but there are other more tangible things that companies need to focus on now.
Alex, can I jump in?
Yeah,
Alex,
go ahead, please.
Yeah. I think that apart from carbon markets, focusing on private investment in the developing world is really an important issue without, if you want, credits. Thinking about why the investment doesn't happen. I think the simple answer is that the risks are very high. They're going to be price risks. They're going to be currency risks, government risk. But if you think about the developing countries and the oil industry, they're traditionally very comfortable in those environments. But they're in those environments because the returns are very high, because they can sell their energy in international markets. So, the way to think about this is, well, how could we turn some of those investments in developing countries into international products? A colleague of mine, Jim Henderson, suggested one which I thought was excellent, and that is that the renewable energy is used to produce hydrogen, the hydrogen can produce green steel, other chemicals, and those can be exported. We can focus more on the global market potential for investments in developing countries rather than thinking about selling to local populations.
Yeah, interesting. And look, I'm very glad that we've moved on to this piece, helping the developing nations, and that big fanfare before day one at COP, the Loss and Damage Fund, which I think is up to about $1 billion now. I'll be interested to hear from you, from all of you, how impressed you are with that billion. It's clearly a long way off from what is needed. But on the investment and the return on investments, it's interesting. I was speaking to Standard Chartered, Bill Winters at Standard Chartered, and his line, and it works, is 54 of the 59 countries they do business with are coastal countries and coastal cities, and unless they do something on the adaptation piece, over 90% of their clients are going to be underwater in 50 years. So there is an urgency there for the likes of the Standard Charters. But how do you make the case for investment? And yes, you came up with an example there, David, but Adrian and Nicholas, I'd be interested to hear from you. How much more, what needs to be done on the adaptation piece, and to what extent does adaptation really need to move up the charts here and be on the same level with mitigation? Do
you want to go first, Nicholas?
Sure. And this is a really key question. I think that we see the hot weather, record hot weather already with us. It's putting pressure on human systems. And I touched on this with our focus on cooling this year. This is real, not just costs for the energy system in terms of higher peaks and the electricity grid needing to meet higher peaks and maintain capacity. Most of the world still doesn't have access to cooling. And this puts immense pressures on health outcomes. And we want to see access increase. And there's lots of different ways of doing this. And so as a response first to the heat, I think this is one of the most urgent imperatives. And governments have a number of frameworks to help address this cost of capital issue. Obviously, with interest rates growing up, this is what we going up. This is what we see as one of the biggest barriers to faster deployment this year. So there's the Just Energy Transition Partnerships, which is helping link various financial institutions with project partners in emerging countries. This year, we had the Summit for a New Global Financial Pact, which also brought together public and private actors to help facilitate projects and bring down costs. And so there are a number of processes underway, and I think getting behind this, but also with an eye just to the fact that, you know, this isn't something that's going to come in 50 years, Axel. This is with us now. It's hitting cities hardest with cooling. And that's I would say the front line.
Okay, Adrian, I'm interested to get your thoughts, and then Paula, I'd like to get your thoughts generally on, you know, how good should we feel about this loss and damage fund this time around? Adrian, go ahead.
Yeah, so just, I mean, how good should we feel? I think it was a good victory, but it's clearly not enough. I mean, you know, 1 billion, whatever that amount is that they've pledged to date, the cost of adaptation is significantly higher. We're talking at least hundreds of billions, yeah. So I think there is much more work to be done there. I'm still not satisfied that we've got a very clear global adaptation objective that's coming out of COP. I think there's still much more of an onus on wealthier countries to contribute to helping those developing countries adapt. And I do think that topic around the cost of capital, which is significantly higher in developing countries, to attract that investment, governments will need to work much more with the private sector to help reduce that risk, because until we can bring that cost of capital down, we're just not going to get the ability to scale up those technologies and help the developing world.
Yeah, I mean, and it seems to me the message from a lot of the investment banks is, you know, they're to the investors and those people who are tasked with making investments, you know, stay away from adaptation projects. You know, it's all about mitigation. I mean, that still seems to be the message coming out of COP and especially among the financial services companies. But Paula, what were you impressed with that fanfare at the start, the loss and damage?
It's not a very big number when you get right down to it. I mean, I think Adrian makes a very good point. It's far short, I think, of the number that is actually needed to really properly pursue adaptation strategies in most countries, well, all countries really. And then there's also no commitment to continue to supply it. Which as well is I mean, that's a huge loophole in terms of making sure that there's adequate funding going forward. And I think, you know, we've been talking a lot about sort of the business environment, but I mean, that's a country environment as well, in terms of what, you know, different governments are willing to invest. And that can often change depending on political shifts domestically as well. And the fact that there's no commitment to continue to supply it going forward is not great, certainly for most countries. And so that's going to be, I think, a big sticking point for it to actually be there. Does that mean that that will not evolve in further COPs? I mean, it likely will. Most of the things we've talked about have evolved over time across numerous COPs, but at the moment it's not sufficient to meet the necessary need.
All right, thank you, all of you, for that. David, I want to come back to, well, I want to change tack a little bit and look at the energy security context and the extent to which that is, to some degree, giving fossil fuel companies a pass, maybe a temporary pass. What can it, you know, can we do both, or does it have to be one at the expense of the other?
No, I think the two are complementary. And I think what we see now, especially in countries in Europe, which import fossil fuels, that renewables are seen as a source of security compared to relying on unreliable suppliers of fossil fuels. So I think there's a real, if you want, complementarity in the argument in the EU for pursuing renewables even faster in energy efficiency, as well as green hydrogen, is precisely security. So I think security and if you want, decarbonization, the transition go together. But if I may, there's a very big issue here, which has to do with stranded assets, potential for stranded assets.
Right.
They're all over the place. You know, part of the, for instance, in the gas sector, there's the risk of stranded assets for networks. But even looking forward, the fact that governments are making most of the decisions now about what's going to get built and how to deal with energy transition, both decarbonization and security, means that investments are basically privately funded, and governments are more or less saying, you should invest in this and you should invest in that. We're now facing a situation where in Europe, we've got a market price for electricity, which is determined by the marginal unit, which is increasingly going to be zero because we're talking about renewable energy. So many investors are worried that the prices in the markets are going to be so low that their investments are not going to be return capital. So governments are going to have to back them up, and governments are going to have even more control over what gets built. So investors should be seriously concerned that the investments that are being encouraged by government are going to be too much, the wrong kind. They should be more actively involved in talking to government about what should get built, because otherwise we could find ourselves 10 years down the road with a lot of assets which really shouldn't have been built and which are not used and useful.
Yeah. Okay. Look, I've got a final polling question. Then I've got some questions from our audience that I want to put to you as well. This is the final poll. To what degree will COP28 impact your business? Be good to get a sense from the viewers as to what you're feeling on that. And again, we'll wait a few minutes to get the result there. Adrian, it's a broad question linked to the one I just asked David. The extent to which oil and gas companies are doing enough to transform themselves into integrated energy companies, have they had a bit of? Are they getting breathing space? Are they getting a bit of a pass now, given the global energy security context? You think?
No, I don't think they're getting. I don't think they're getting a pass. I also think more broadly, the oil and gas sector has the potential to be an important enabler in delivering the energy transition. Now, that may not be a popular story or perspective amongst many of our listeners, but they have, many of these international oil companies, for example, have significant capital to deploy, and we're going to need a lot of money to develop our low carbon energy system. They have a global footprint, which means they can deliver projects in the global north and the global south. And they have very strong project management, engineering, technical excellence that will be required as we scale up many of these technologies. I'm not convinced they have a coherent narrative about what their role will be in the transition. And I think that's one of the big challenges. And I think this COP was an opportunity for some of those players to step up. I think the other thing is the oil and gas universe is very broad. So you've got small independent E&P producers, you've got integrated international oil companies, you've got national oil companies. There are lots of different players and with different agendas. I think, coming back to the original point, they can make a really valuable contribution to acting as a catalyst to enable the transition. I'm not convinced they've all stepped up to that. Okay.
There's a few questions I want to put to you from the audience, and there's something on carbon pricing, Paula. In terms of the progress that's been made on carbon pricing, and it seems to me that companies are very much setting their own prices, and prices are all over the place. I think from about $1 to $1,500 per metric ton right now. Obviously companies getting ready for emissions regulations. Where are we on carbon pricing, and again, how quickly is this going to get to a place where it needs to be?
Again, it depends on the type of carbon market you're talking about. So all allowances within an existing ETS system look like each other, right? So it becomes very easy to standardize that pricing. And so you see very clear pricing transparency for allowance prices. You can also see fairly clear pricing for the delivery of credit-based systems into a national ETS, because you have a limited number of methodologies that can meet, right? So ACUs are an example of this. So you'll have, one price for an ACU generic and then another one for HIR. Those are two separate methodologies, so they have two separate prices. It's fairly clear. I assume the question is referring to the wide variety of different pricing that you see across voluntary carbon markets. And the truth is that is very, very difficult to standardize. And issues that we've had so far in trying to standardize it have made those contracts difficult to trade, because when you're actually trying to standardize a price, the price is always going to be the floor of the lowest sort of deliverable project. And so that becomes then a bit of a problem when you're trying to actually make sure that you're getting delivery of high quality projects. I think you asked earlier about the ICVCM, and I think the adoption of CCPs will actually probably make that a little bit easier, because you'll have that CCP bar, which will be your new floor. But again, it depends on sort of whether or not that becomes the floor that people are willing to accept and are comfortable with.
Why are we
Credits
talking
in general have different attributes
sorry.
that make it difficult to standardize them. You can't take a project in one location and basically lift it wholesale into another location, because it wouldn't necessarily work. They're location specific, they're based on certain needs. Those are all individual attributes which have different pricing mechanisms attached to them, and it becomes very, very difficult to standardize that. So if you do pursue standardization, you're stripping off a lot of the individuality that makes carbon credits in a voluntary system work.
Yeah, and I guess it comes back to that debate, whether this should be voluntary at all, whether this should be properly regulated, this space.
And there's a question about whether or not a fully functioning Article 6 leaves an enormous amount of room for additional voluntary carbon credits. And it might not, right? Like if forestry in particular becomes a national asset that is traded in an Article 6 world, which again, we are still some ways away from, but we're starting to see attributes of that, then it's not necessarily available for a voluntary carbon credit market the same way. Different nation states have started adopting their own ETS systems, which use voluntary carbon, or what were once voluntary carbon credits, for national trading. That is no longer a voluntary market, that becomes a regulated one. It doesn't necessarily talk to other regulated markets, but it's one that is sort of based around sort of a more sort of standardized regulated system than what you see in the voluntary market.
Okay, good, thank you. Nicholas, this comes in for you. It's a broad question, but how optimistic are you that governments will sign the Global Energy Efficiency Pledge at 28?
Right.
Yeah, go ahead.
Yeah, thanks. Well, we've already seen 60% increasing of the world sign up to this efficiency pledge. And so I would say as a good economist, I'm 60% optimistic at the moment, and that we've gotten part of the way there. And I think over the course of the next year, this is the beginning of a process where we'll see building momentum behind efficiency, renewable energy, and the global pledge, and more countries will sign onto it as time moves on. So I think it doesn't all hinge on COP28, although this has been a very important moment for building momentum, but there's more to come down the path. And I think it's imperative that we use the momentum to reach even further beyond what wasn't able to be achieved at this COP, because as our latest analysis showed, the pledges that have been made only get us 30% of the way to net zero currently. And so even if all the countries that have signed up deliver on that, we still have quite a long way to go. So continuing is really important.
And of course, they are just pledges at this stage, which is something we were reminded about every moment especially by sort of developing nation actors on the scene at COP. Adrian, by the way, just no great surprise, but to what degree will COP28 impact your business? A major impact driving future initiatives was the one that won out there. No great surprises there. But on that, Adrian, what and the sort of advice you're giving to your clients when it comes to lining themselves up, being in the right place, deploying the right the funds in the right place. What's the message, the main message you're giving to most of your companies right now, would you say?
So just two things. One, point B, major impact driving future initiatives. Yes, absolutely. I'm not surprised that's the answer. The COPs are effectively, they're an indicator of the direction of travel, that the hard work, the heavy lifting needs to be done year on year, day on day by companies and governments. So I think that gives us a direction of travel, and business needs to respond to that and accelerate. The advice that we give to all our clients is pretty simple, which is have a clear net zero strategy. How are you going to deliver it? How are you going to measure progress? What other initiatives can you do? What are the portfolio of options you can do to help decarbonize your business? And we believe very much in helping our clients deliver that. And again, sorry, I sound like a broken record, but working in partnership between government and business in order to deliver that, because I think that is the way that we're going to deliver this transition.
David, final question. Are you heartened by what we've seen come out of COP28? Again, there was fanfare at the start with the funds and the general financing pledges that we've seen. The cooling pledge, of course, was another thing. Yes, there's worry over the language in the final communique. But Sultan Al-Jaber, speaks optimistically, while Guterres, for the UN Secretary General, throws dark clouds over the process. Where do we stand on the back of this? And also taking into account, we don't really know where the next COP's going to happen. I think it's Azerbaijan, but what are your thoughts?
Well, as I said at the beginning, my thoughts are that whatever happens here, the transition, the direction of change is clear. It would make a difference to the speed of the transition if there were a more ambitious final communique on fossil fuels. But I insist on the importance of what has been achieved. We haven't mentioned the methane issue, which is an important commitment to reducing emissions by the companies themselves, both public and private. We haven't mentioned the Energy Transition Accelerator, which is a way to give private investors some certainty about, if you want, investing in credits related to renewable energy in developing countries. So I think these are positives. I think that the final communique will make a difference. But at the end of the day, I think that the really important new initiatives are going to come in bilateral agreements, national agreements, climate club idea of the countries that want to go quickly working together, the US, Canada, the European Union, and a number of other who have created this club. And I think that's a really good idea. But at the end of the day, I think we have to recognize that the direction is clear, and that we now have to. I think all companies should recognize that even if you want, the final communique is not ambitious, the clear direction of change requires companies to take it very seriously. That the transition is here to stay.
All right. Look, I'm going to have to stop it there. We've reached time, but I want to thank all of you for a really interesting discussion. And it was very timely, of course, given that I think today's the official last day of COP. So we'll see what does come out of it. So thank you to Adrian, to Paula, to David, and to Nicholas. It's been really super. Your feedback, by the way, as it says here on this slide, is important. Scan that QR code and fill out that post-event survey. But that is it for this series. That is it for 2023. The Al-Attiyah Foundation, in partnership, of course, with the London Stock Exchange Group, Data and Analytics. Watch this space for plenty more ahead in 2024. I wish you all a very happy holiday when you eventually get to it. And thanks to the panel again.